Could we be possibly looking at a three-quarter bear, 3Q quarter three bear rally for the next few weeks? Looks good if news stays the same. That's kind of what I'm thinking. I'm thinking we don't have anything very bad coming up. There's some catalysts, but right now they're all kind of like the Japanese treasury issue is being stabilized. The British gilts issue is at least considered by the market fairly stable until the end of October. So like the big dangerous catalyst, Dixie's dropping, so dollar liquidity is improving. So I think the big dangerous market catalysts are kind of a little more neutral right now. I guess the wild card there is the Ukraine situation. Something could change with that over the rest of today into tomorrow, and that could, upset things. But right now, I would say no news is good news. And the market is being moved on positioning alone. And so it makes it a little easier to predict the potential outcomes. So yeah, I think it looks good. I think we look really good for a rally. I mean, honestly, a lot better than we looked on the August rally. Upstart Gamma Max mentioned, tuned in late. So, Upstart keeps giving us gamma values of like 56 to 80, and they're kind of like in a very high range, right? And a lot of this is out of the money call buying. Upstart has like a crazy number of strikes to the upside, but really Gamma Max is probably like at the median point there, somewhere around like 30 to 32. And also call buying in this range is very, very heavy, right? But the interesting thing about Upstart is from $30 up, Gamma is flat, right? And that means that it can just keep moving. So if it starts going up like crazy, there's really nothing stopping it, if that makes sense. How often have stocks run while on RegSHO for OPEX? Not very often. ETFs, they don't care, but individual equities, it's kind of a big deal. GME ran while on RegSHO for OPEX leading into January 2021, and it was very, very bad for the people short GME and causing those failures. I'd imagine the same would be true for Upstart. It's not a good situation to be in, to use synthetic liquidity to cover the synthetic liquidity obligations is a very dangerous position, and it massively increases their tail risk. So if they run it and they're unable to get it off RegSHO, they're in a very, very dangerous position in terms of their risk. They would need a very large sell-off in order to so I mean, consider what Jan 2021 really was an attempt to get liquidity, right? Because so many positions needed it. You had, volatility positions, you had shorts, and, the liquidity was all being sucked up by longs going full bull. And it made it very, they had to keep running the price until they could unlock sufficient liquidity, which they really didn't do until like January 29th. And then when they got it, they were finally able to bring the price down. And even in bringing the price down, it still spurred, February, because they used so much synthetic liquidity to bring the price down, right? That next February OPEX was still super explosive. And it takes a really long time to unwind all that synthetic liquidity creation, which we saw over the early part of last year with GameStop. So if Upstart runs while on RegSHO, it can't be shorted without a pre-borrow agreement, right? So the only way to short it is with puts, which means, massively increased volume, because, you have to use a put to short, or through ETFs, which means you're creating obligations, right? And if the price keeps running and you keep creating the obligations that are already running the price, it's a very sticky situation. Options going green is actually scary for me. I've not taken profits when I should have, but I've also taken $25 profit on a surprise run and missed out on another 600 over the next 48 hours. If you have I don't. So it's one of the reasons I really don't like super small options positions, like 1 or 2 contracts. And I don't like the way people handle large options positions, like 100 contracts, right? People tend to make similar mistakes with both of these. They get panicked by seeing green on big positions, and they just don't manage small positions well. It's really nice to have like 10 to like 50 contracts, and like a stable range, because you can sell like 50% at a very comfortable level, and your cost basis is covered, and it reduces the stress of having to manage the position for the rest of the time that you hold it, right? Because the money you put in has already been made back. So now you're just playing with, like, a lot of people like to call it house money, right? And obviously this money is important, these are your profits, but it takes a little bit of the stress off and makes people a little less skittish. So if you have an opportunity to capture your cost basis and let some ride, don't be afraid to do that, because you'll manage your position better, especially if you are prone to being kind of skittish with your gains.